This is the story of Wall Street's largest precious metals manipulation case. September 2020 brought a $920 million settlement after JPMorgan Chase admitted its traders ran systematic fraud across global silver and gold markets for 8 straight years, leading to 5 criminal convictions, including the desk head receiving prison time and the bank confessing to placing hundreds of thousands of fake orders that sometimes accounted for 50 to 70% of visible gold and silver markets at any given moment. The settlement opens up a bigger question though. While JPMorgan manipulated silver prices downward through illegal spoofing, was the bank simultaneously building what some analysts estimate could be the largest private silver hoard in modern history? Those estimates put the number at 750 million ounces, worth roughly $22 billion at current prices, which translates to 46 million pounds of physical silver sitting in vaults. What got proven in court and what remains unproven paint 2 very different pictures. Let's separate documented facts from speculation. September 29th, 2020 marked the day JPMorgan entered a 3-year Deferred Prosecution Agreement with the Department of Justice, and the settlement breakdown shows exactly how serious this was. Victims received $311.7 million in restitution. Disgorgement cost the bank $172 million, and civil penalties added another $436.4 million on top. This wasn't a fine to make a problem disappear, but rather an admission of guilt. Between March 2008 and August 2016, numerous traders and sales personnel on JPMorgan's precious metals desk across New York, London, and Singapore engaged in a scheme to defraud, according to Department of Justice documentation. Spoofing was the method, which meant traders placed massive buy or sell orders they never planned to execute, creating false impressions of market supply and demand before canceling those orders once other traders reacted. FBI Assistant Director William Sweeney put it directly when he stated that for nearly a decade, a significant number of JPMorgan traders and sales personnel openly disregarded US's laws designed to protect against illegal marketplace activity. What makes this particularly damning is that these weren't rogue traders operating in the shadows. Multiple traders across 3 continents spent 8 years running this operation systematically, and the scale wasn't small, considering we're talking about hundreds of thousands of fraudulent orders. Greg Smith took the hardest fall as the executive director and head gold trader, receiving 2 years in prison plus a $50,000 fine in August 2023. After prosecutors labeled him the most prolific spoofer the government has prosecuted to date, Judge Edmund Chang didn't mince words at sentencing when he told Smith directly that he told many lies to the market and injected fraud into it for many years. Michael Novak ran JPMorgan's global precious metals desk as managing director and even served on the London Bullion Market Association board while simultaneously operating a fraudulent scheme which earned him 1 year and 1 day in prison along with a $35,000 fine. John Edmonds spent 13 years at JPMorgan before pleading guilty in October 2018, and his decision to become a government witness delivered devastating testimony. He admitted learning to spoof from senior traders with supervisors' knowledge and consent, while Christian Truns corroborated the story by testifying that Smith spoofed all the time, and colleagues joked he needed to put ice on his fingers to cool them down from rapid clicking. But here's where it gets interesting. While these traders got convicted of spoofing, fraud, and attempted price manipulation, the jury acquitted them all of RICO racketeering charges, which means the precious metals desk didn't qualify as a criminal enterprise in the jury's eyes. That distinction matters when separating what got proven from what got alleged. March 16th, 2008 was when JPMorgan acquired the failing Bear Stearns, and Bear Stearns just happened to be the largest short seller in COMEX gold and silver at that moment. Silver hit a 28-year high of $21 per ounce the very next day on March 17th when JPMorgan assumed control. CFTC correspondence to lawmakers confirmed JPMorgan inherited Bear Stearns' massive short position, and by August 2008, bank participation reports showed 2 U.S. banks controlling 98.6% of all net shorts in COMEX silver futures, with positions representing 153% of deliverable warehouse silver. The timeline creates an intriguing pattern when you consider that JPMorgan inherits the largest short position in silver. Prices immediately start declining, and according to DOJ documentation, systematic spoofing begins just months later in March 2008. Correlation doesn't prove causation, but the timing deserves attention. Now we arrive at the most controversial claim floating around precious metals circles, which suggests JPMorgan accumulated somewhere between 700 and 750 million ounces of physical silver. That figure would be worth approximately $22 billion at current prices and represent one of the largest commodity hoards in history. The verified facts tell us that JPMorgan opened its COMEX silver vault in March or April 2011, starting from 0 ounces, and by 2016 to 2017, the vault held 80 to 112.5 million ounces, representing approximately 53% of total COMEX silver inventory. Late 2025 data shows the JPMorgan vault holding approximately 169 million ounces, which accounts for 40 to 50% of COMEX totals, and these figures come directly from CME Group's daily silver stocks reports that anyone can verify. Ted Butler, a precious metals analyst tracking JPMorgan's silver activities since 2008, generated the much larger 750 million ounce estimate through a methodology that combines verified COMEX vault data with theoretical additions. His calculations include alleged acquisitions through JPMorgan's role as SLV ETF custodian during share liquidations, estimated purchases from US and Canadian mints, and speculated holdings in unreported London vaults. Butler's estimates grew over time from 200 million ounces in 2014 to 350 million in 2015, and finally, 675 to 750 million by 2018, which means these larger figures represent analyst speculation based on inference rather than confirmation from official sources or JPMorgan disclosures. Two numbers exist in this discussion. The verified number sits at 150 to 170 million ounces, worth about $5 billion, while the estimated number claims 750 million ounces, worth about $22 billion. One is documented fact and the other is informed speculation. JPMorgan wasn't operating in isolation when you look at the broader pattern. Deutsche Bank settled for $38 million in 2016 and handed over more than 350,000 documents plus 75 audio recordings as evidence, with those materials naming UBS, HSBC, and Bank of Nova Scotia as co-conspirators. The chat logs revealed coordination that went beyond isolated incidents. Traders followed an 11 o'clock rule to short silver at specific times, called themselves stop busters for triggering customer stop losses, and discussed expanding their mafia to include Barclays. One trader's message laid it out plainly when he wrote that they needed to do it the same next time because if they were correct and did it together, they could screw other people harder. Documentation from 2007 to 2013 showed coordination among multiple major banks, which corroborates a pattern of manipulation extending well beyond JPMorgan alone. Silver's physical market fundamentals explain why manipulation matters in the first place. The Silver Institute's World Silver Survey 2025 shows that 2024 mine production hit 819.7 million ounces, while total demand reached 1.16 billion ounces, creating a deficit of 148.9 million ounces that marked the fourth consecutive annual shortfall. 4 years of deficits from 2021 to 2024 add up to 678 million ounces, which equals 10 months of global mine supply that simply vanished from inventories. Industrial demand reached a record 680.5 million ounces in 2024, and solar photovoltaics alone consumed 232 million ounces, representing a 158% increase from 2019 levels. London Vault and COMEX inventories dropped from approximately 1.2 billion ounces in 2020 to about 750 million ounces in 2025. If Ted Butler's JPMorgan estimates held up, the bank's alleged holdings would represent 40 to 90% of annual mine production, and that level of concentration would grant extraordinary market influence, especially when combined with proven spoofing capabilities. The legal record requires precision about what actually got established in court versus what remains theory. Courts proved that JPMorgan traders engaged in systematic spoofing from May 2008 to August 2016, placing hundreds of thousands of fraudulent orders that caused artificial prices and over $300 million in victim losses. Senior traders, including the desk head, knowingly participated while the bank failed to stop misconduct despite red flags showing up repeatedly. What never got proven in court includes claims of a coordinated long-term scheme to suppress silver prices below fair value, government direction, or protection of JPMorgan's activities, a specific physical accumulation strategy to profit from suppressed prices, and Ted Butler's larger holdings estimates beyond verified COMEX vault data. Spoofing involves short-term price movements for immediate trading profits, and courts confirmed JPMorgan engaged in exactly that behavior. Systematic price suppression would require maintaining artificially low prices over years or decades, but no legal proceeding has established that happened. Jeffrey Christian of CPM Group maintains that spoofing produces no long-term effect on prices, and he points out that JPMorgan spoofed in both directions rather than just to suppress prices. Judge Robert Patterson dismissed a class action lawsuit against JPMorgan in 2013 after noting that silver price movements mirrored platinum and palladium, suggesting market forces drove prices instead of manipulation. Benzinga published an analysis in October 2025, concluding that regulators found spoofing activities distorted markets but never concluded that JPMorgan set or maintained a specific silver price over time, which means it wasn't a coordinated attempt to fix silver prices at a particular level. The documented facts established that JPMorgan paid $920 million and admitted to 8 years of systematic fraud in precious metals markets, while 5 traders received criminal convictions. JPMorgan's COMEX vault holds 150 to 170 million ounces of silver, representing roughly half of all COMEX registered inventory. Deutsche Bank's evidence confirmed multiple major banks coordinated similar manipulation, and the physical silver market has run deficits for 4 straight years, while industrial demand hits record highs. What never got proven is whether JPMorgan accumulated 750 million ounces total, whether the manipulation served a broader suppression strategy, and whether the bank deliberately bought physical silver at artificially suppressed prices it helped create. The documented facts alone represent the largest precious metals fraud case in history. Whether it's part of something larger, and whether JPMorgan truly flipped from the biggest short to potentially the biggest long, remains a question of informed speculation rather than established fact. The CFTC investigated silver manipulation from 2008 to 2013 and found no basis for charges, while the DOJ later proved criminal conduct during that exact period, which raises perhaps the most troubling question of what else regulators missed while looking directly at the evidence.